The war is erupting in the Middle East, and while many people might be afraid of the potential impact of it on their lives, the market doesn't seem to be bothered at all at the moment by this phenomenon. Add to this, while the interest rate has slowly started to get cut, the stock market on its side has been on a full bullish movement. So, are there still great undervalued companies available on this crazy market right now? Well, this is what you'll be finding in today's video, where I'll share with you 3 of the best stocks to buy right now in October 2024. Without further ado, let's take a look at the first pick on my list. The first company that looks pretty promising for the future is Shopify with the ticker SHOP. This e-commerce giant that is now worth over $100 billion has been rallying since a few months now, but the positive news for the investors is that we are still far from its all-time high. This positive momentum has been created mainly by their strong financial results lately, where we've seen that in their more recent earnings report, the total revenue of this company over the last quarter have been jumping by over 21% year over year, which has driven their profitability margin up by over 25%. But to understand this crazy growth, we need first to understand how they've been able to generate over $7 billion of revenue in 2023. As many of you might already know, Shopify is an online platform that offers multiple types of features to their subscribers in order to build an online website. So it is a simple and easy way for businesses to propose and sell their different products and services to their different customers all online. It is why most of Shopify earnings are generated either from their subscription services or from their merchant solutions. As its name is saying it, the subscription services is the fees that the different users will be paying to Shopify to use the platform. It can be per month or per year, going from $28 per month to over $2,000 per month. Then the second income source of Shopify, which is its largest one by far, is the merchant solution. This is basically a commission that Shopify will be earning every time that a certain sale will be made by their websites. Globally, these fees tends to be between 2.4 to 2.9% per transaction. So you can understand that the company would be earning between $24 to $29 per $1,000 of transactions made with their different services. It is why when we know that Shopify controls over 32% of the e-commerce platform market that is expected to exceed over $4.1 trillion of sales in 2024, it is no wonder why this company is able to generate that much revenue. Add to this with a gigantic jump by over 243% year over year in their total free cash flow. This is showing that the company is getting more and more profitable because notably they are able to keep pretty much the same type of capex while being able to massively increase their total operating income. And so even if at the moment, as many different technology companies, Shopify currently has a quite high price to earnings ratio, with the project growth that is expected by many analysts to be about 45% of growth on average for the next 5 years in terms of their total earnings per share progression, well, it makes that it is definitely a company that I'll keep an eye on for the future. Add to this, since the pandemic, we've assisted to a massive growth in the total e-commerce market that is now expected to continue to grow at an average pace of about 8% per year for the next couple of years. Now, for the second company on my list, we are going in a totally different sector that could benefit from a potential conflict in the Middle East, and it is the energy sector, where I've decided to pick the ExxonMobil company with the ticker XOM. With the ongoing conflict that is currently going on between Israel and Iran, this could have a solid impact on the total oil price value. Indeed, while we know that Iran is currently amongst the 10 largest oil producer countries in the entire world, a potential conflict could have the impact to make the price of the barrel surge. Then another positive news that could impact the value of this company is the potential decrease of the interest rate by the Fed that is forecast for the next couple of months. While the Bank of Canada has already started to make many cuts of the interest rate over the last couple of months, the Fed has followed since September. Some of the great beneficiaries of these types of news is notably all of the companies that have a lot of debt. On its side, ExxonMobil is one of them, where we can see that they currently have over $43 billion of debt with some interest payments that have been increasing over the last 2 years. So basically, to have lowered interest rate will have the impact to lower the total expenses of this company by also increasing their total profitability. This will be pretty interesting for this type of business that is used to make different acquisitions financed by debt, notably in 2024, where they've acquired Pioneer for over $60 billion. This merging notably had the objective to help Exxon Permian production to more than double its volume to 1.3 million barrels of oil equivalent per day. At the same time, in their latest earnings report, ExxonMobil has been able to increase both their total quarterly revenue and their total earnings per share year over year, exceeding even the analyst predictions. However, we've also assisted to a certain decrease of their total free cash flow year over year for the same period. This type of phenomenon is normal because it was driven by higher capex that were justified by the acquisition notably of Pioneer for more than $60 billion. However, with the current raging conflict that is going on right now in the Middle East, over the last month we've seen the value of this company increase by close to 10%, and since the beginning of the year it has been increasing by a grand total of close to 20%. Plus, what is pretty interesting also for the different income investors is all the income that you'll be able to generate from the different dividends that this company is offering to their shareholders. Indeed, by offering a dividend slightly over 3% with a super low payout ratio of only about 45% right now, we can understand that this dividend growth company that has the record of increasing its dividend for the last 41 years in a row could still continue to increase it in the next couple of years. Finally, the third and last company on my list is the company Dr. Horton with the ticker DHI. This business that is currently the largest home builders in the US could greatly benefit from some lower interest rate. Indeed, by operating in over 118 different markets in 33 different states across the United States, D.R. Horton has been able to build and sold over 1 million houses since its creations back 45 years ago. Their total properties doesn't include only single-family houses, but also different multi-family rental properties. Only over the last year, we've seen that this company has been able to sold over 84,917 homes in its home building operations, in addition to the total 5,860 single-family rental homes and 2,112 multi-family rental units in its rental operations. And the great thing about the business is that they are not strictly focusing on high-costing and expensive houses, because about 90% of their total productions are houses worth less than $500,000. From an investor point of view, this company is also pretty interesting for the consistent growth that they are able to provide, as we can see by their latest earnings report, where they've been able to increase both their total quarterly revenue and their total net income year over year. Add to this, their market dominance in the US is continuously increasing, where we can see that they are sitting close to 14% of the total homes closed in terms of the US single-family new home sales. And so, since housing is an essential services for everyone, and since Zillow has said that the country would still need another 4.5 million homes to solve the housing shortage in the US, it is still an excellent company to keep on your watch list for the month of October 2024. Plus, with the anticipation of other multiple rate cuts that could be coming from the Fed over the next couple of months, this will typically lead to lower mortgage payments, and it will become even more attractive to different American buyers that are looking to buy their first house. And so this could be pretty favorable for this type of company in such an environment. Add to this, while the American elections are shattering the public opinions in the US, one of the measures proposed by Kamala Harris would be some tax incentives for home builders that sell homes to first-time home buyers. It makes that if she would get elected, this could make the stock's value of DHY surge. It is why even if the company's value is up by more than 70% since 1 year and by more than 20% year to date, with a price to earnings ratio of only 15 and with the necessity that they are offering to the American public, this is definitely a company that I will be keeping on my watch list for the future. So there you have it. Those were 3 of the most undervalued companies that you can currently find on the stock market for October of 2024. But now on your side, if you're looking to find what are the different transactions that I've made in my investing portfolio over the last month of September, well, you can check out the video that's going to be right over here, and I will see you soon. Peace.